All right, folks, welcome back. This is our Monday commentary for the ICT Mentorship. And we're looking at the dollar index daily chart. So I'm going to have a trade example here today. And I'm going to cover another trade I showed one of my sons on Friday. So we'll go into a little bit of that towards the end of the video, but I just want to go through the normal commentary. So the daily chart here, we saw a retracement last week going out into the order blocks here. So we have last down close candle here, the opening price. That's that dashed line here. So when you drop down the lower time frames with me, you'll see that that is that opening price here. Then you have the two levels here that are anchored to the opening price and the wick high. Notice the bodies of the candles respecting consequent encroachment of that gap that is represented by the wick right here. So we're looking for the likelihood of it continuing on the upside. As I mentioned last Wednesday, because we didn't do a Thursday or Friday or weekend commentary past Wednesday. Wednesday of last week was the quote-unquote weekend commentary and midweek commentary in observation of the Thanksgiving holiday. So I hope all of you had a very pleasant Thanksgiving if you celebrate that. If not, sorry. But here is the upside draw on liquidity. It's the imbalance on that weekly chart. As I mentioned, go back and look at the commentaries from last week. You'll see what that is. All right, so the dollar index hourly chart here, you see that opening price on the lowest down close candle on the daily chart trades into that. And then we have the gap opening on the week. So the weekly gap opening here, the discount low, premium high. We open, trade up, and then come right back down into it here for a return back to fair value. So price shows a willingness to want to rally from here. Attack the buy side here. Now notice all the price action in here. See all these tails and come right back up. This is redeliver, rebalance. So if we see an upside, and I'm favoring that at the present, there's a small little imbalance right in here with a order block. You see that? Everything else is a lot of back and forth overlapping of price. So if we do expand on the upside, I'm focusing on right there and that order block. Okay. If we lose the opening on the week, then it could become a consolidated, sloppy trading week. So in other words, I prefer to stay bullish. All right, here is the 15-minute time frame on the dollar index. And again, you can see how we traded down into the weekly gap opening. And then the market rallied, came back down into the order block. Fair value gap. Rallies, comes back down in. Order block, does it send price higher? Yes. Where does it go? Buy side liquidity. And then rallied one more time here. And then consolidated. It looks like it wants to go a little bit further. But at the time of the recording here, it's a little past noon local time on the East Coast. So we're essentially London close. I'm going to try to do these videos early like this and get them done. So that way we're focusing on what the market has done during London and in the New York session at the London close, capping the intraday volatility. All right, so we're looking at the daily chart of the euro dollar. All right, and euro dollar last week, I mentioned on Wednesday that I'd like to see it just get down here to the premium high of the imbalance. That would be enough for me. I'd be satisfied with that. And as you would have guessed, luck was on my side. And the market trades down into that completely random shaded area that no one knows why it was even there. I know I'm being facetious. Trading lower, trading into it, and then as I mentioned on Wednesday, the fact that we traded there, you don't look at new shorts. Okay, you don't go into the market saying, okay, it's going lower, so therefore I got to go short now when it's already hit a higher time frame objective in the form of a discount array. This weekly discount array is a big deal in terms of targeting. So it's not unlikely for it to have an exaggerated retracement. And we had that here on Friday. It came up and hit the bearish order block here. And then today we're seeing the repel off of that. So we'll see if it wants to keep this fair value gap in here and trade higher, and then come back down to it at a later time with the order block, bullish fair value gap, and send it higher for this area here, or melt down into the lower objectives here, which I kind of favor that because of the bullishness on the dollar. So I want to kind of see that that does what I'm expecting in that regard. But even if it doesn't, you'll see that I've already shown a opportunity to take the weekly objective that I'm training you all to strive for initially as developing students. And we'll get into that when we get into the pound. All right, hourly chart on euro dollar. Again, you can see we traded into that last week. And I mentioned you don't want to look for new shorts there because we've met an objective. And we're treating last week like non-farm payroll, where if we do get volatility, who cares? We've met our objective. The market traded to where we were looking for, and the market trades back down into that level again. Here, comes out of it, comes back down in, and then ramps it right up into this imbalance right there. And that red level here is the bearish order block on the daily chart. Okay. Now on Friday, I was talking to my son, talking about how we were trading in here, down into the order block there, without having traded up into this imbalance yet, and or hitting the bearish order block on the daily chart. So I took a trade on here, which I will show you later on at the end of the video. Okay, but for now, just this is the framework here, and it rallies up and fills it in, and I took partials, and then one more attempt as it goes higher and hits the objective. So my limit order was hit, and that was a Friday session example that I didn't really have intentions of sharing with you all, but he was like, you know, can you do this again on Monday, Dad? And well, I went into, not with the euro, I went in with cable, and you'll see a recorded version of that, but I just simply over the shoulder did this trade with him, but you'll see it in the history. I'll show you the whole thing. All right, so we're looking at, again, a lot of overlapping in here with the delivery of price. So you're gonna have to go through all that and go back down into this candle here. And there's a small little fair value gap there. Do we need to go up into that one more time? I don't think we need to go back up in there because we already had this candle trade up into institutional order flow entry drill there, and then sells off. Okay, again, gap, gap, institutional order flow entry drill, not fair value gap that looks to be completely filled. We don't need that in this instance because we have this signature that I'm teaching you. So we'll see if it wants to trade lower off of that. It's kind of late in the day. Don't hold too much on that. And obviously by the time you watch this video, it's already moved. But the point is the logic used at a better time of day, like say it was the New York Open, and we haven't even traded to the equities open at 9:30 yet, and we had this candle here. That would be enough for me to assume there's going to go lower and maybe tag this little area in here for a scalp. That'd be a nice little run in there for 20, 25 pips. All right, euro dollar, 15-minute time frame. Okay, you can see the order block in here, trades into it again one more time, rallies up, takes out this short-term high, and then gives up the ghost. Small little fair value gap in here. Why is this a fair value gap and not an institutional order flow entry drill? Because there's no gap over here. Okay, it's closed in. This is all by itself. So fair value gap. See that? You're learning. Ain't that neat? Mentorship. It sells off from here, trades into all of this consolidation in here, and then goes sloppy into today, where we rallied, failure, breaks down, trades up into the breaker, high, low, higher high, bearish breaker, sells off aggressively for the sell-side liquidity there. To me, it looks like it wants to roll over and go lower, but again, we'll see. I favored the British pound today, and I'll show you reasons why. So here's pound dollar on its daily chart, and the framework is we trade off this bearish order block, attack the sell-side liquidity there. I didn't have a clear downside objective. I just felt that it was likely to trade lower, and if you look at the daily and weekly charts, there's really nothing that is clear in terms of what it may be reaching for, which is almost concerning for the pound, because it could go a lot lower in that regard, because if there isn't a clear key level in the form of a discount, it might go for a really far lower level one. Assuming, again, this is a lot to do with a continued bullish dollar. So that's the caveat here, okay? But anyway, we had price trade up into this old low there, and inside of the consequent encroachment of this candle's tail. Split that in half, hits it there, and then intraday we saw it rally up, fail to take this high out, and then start to break down. Now I'm thinking, well, I want to go short. So let's go into lower time frame charts, and this is what I see. This morning I saw we hit the rejection block on this pass here. Didn't go up above this high here, and it started to break down. So in my mind, I'm bearish. I'm looking at this lows. It rallies up. I'm expecting to sell off. So this is going to be what? Market maker sell model. So let's go into the 15-minute time frame. So here's the 15-minute time frame, market maker sell model here. And I tweeted this, well, not tweeted it, listen to that. I posted it on my community tab on my YouTube channel this morning and asked, what do you see? Now, it's clearly meant for you all here, but the original consolidation is here. Accumulation, reaccumulation, smart money reversal. There's a low risk sell in here, distribution. The second stage of distribution in here attacks what? The sell side. So the largest magnitude, the greatest amount of speed and velocity getting to the liquidity is going to be on the second stage of distribution. Okay? And here we have it. Obvious, isn't it? Now, I'm going to take you into a live execution that I recorded and showed this very condition and targeting the sell side in here. If we see continuation on the downside for a longer term position, short-term swing trade would be here, okay? But for the sake of giving you further illustrations of what you're looking for as your initial objective, what is your first stage of proving to yourself that you're getting to where you need to be at in terms of your development? After you go through the first year in core content and you have a lot of the material digested, doesn't mean you know it, it just means you digested it, okay? And now in charter membership, you see specific price action models and elements that lend very well with pulling certain concepts and theory from core content to make a price action model or a trading plan, okay? And this is kind of like leaning on the ideas that I teach in model 6 and 7. And again, this is what I do. Like when I go into charts, I'm looking for that market maker sell or buy model. And I don't care if I missed the ideal exit on a long up here and then getting short. I don't care about that. I don't care that I missed this one here because I'm really waiting for that second stage of distribution if I'm bearish. Because I know, as I'm teaching you, and this is just, again, further illustration, that these concepts work. It's undeniable. You cannot wrestle with it. You cannot argue with it. It works, okay? The problem is you want it to work immediately the first time you watch a video, and that's not going to happen. You have to practice. And I'm not cherry picking, okay? You watched me zero out the account down to 10,000 after 200,000 or whatever it was. The idea is, how can I get your mindset on thinking income setups? Okay, not I'm going to win, the Olympic trading contest. That's down the road for you if you want to go that direction. For now, I want you to think about how little you have to do to be consistent, harvest the pips, and use sound money management. Not crazy optimal F, trying to double the account every week. That's not something that you should be wanting to do as a developing student, okay? Because you don't even have the skill sets to operate consistently for setups, let alone manage the, the aggression in very high stakes money management, because that kind of stuff is very stressful if you don't know what you're doing. Because you're just putting a one mini lot on live trading the first time, it's going to almost give you an ulcer because you're afraid of the outcome. You're putting everything and all your hopes and fears on that one transaction. And that's why you have to desensitize yourself with a demo. You have to do it so you don't even care. You don't care what the outcome is. You're just following the rules. You're looking for something to deliver a specific way. The characteristics and theory that I teach you about these specific signatures in certain market structures, that is the thing you're looking for. Those reoccurring phenomena, these patterns that repeat within a logic that is discernible by reading price action. In layman's terms, you're looking for times when the market is so clearly showing its hand. You're not looking at all this over here. You're not worried about all this price up here. You're not worried about this run from here to here. You don't care about that. You see that it's ran from here to here and it's sold off, and you had one leg of distribution here. And we're starting consolidating here. So when we drop down to a lower time frame, which I'll show you later in the video, on a 5-minute chart, in here, you are matching up an old area of accumulation with distribution here. So you'd expect to see what? Second stage redistribution in a market maker sell model, attacking the liquidity right below here. Because we're bullish on dollar, it has not changed. Do we look for just a shallow little run below that low? No. If we were bullish on pound and bearish on dollar, then yes, that's how we would use the market maker sell model in this instance. But because we're bullish dollar, that has not changed. We want a deeper run in on this sell side liquidity, and we have these lows over here, and then you have the low over here as well. All right, I mentioned last Wednesday the indices were flashing a bearish divergence, and we have the higher high on NASDAQ, we have the lower high on Dow, and we have the higher high on S&P. And then we had Armageddon on the downside for the S&P, and over 1,000 points decline on the Dow, which is not surprising because look closely. And this is your homework assignment for tonight, okay? This area here is your original consolidation. Accumulation, reaccumulation, smart money reversal, low risk sell, distribution, and then in here, what is this? Another stage of distribution, then crush. So I want you to map out this entire fractal here from this area here to here on Friday. Map that out on a hourly and 15-minute time frame, and that'll be the homework assignment. See what you get in terms of your markup, which would be, I guess, a backtesting example or logging example for Dow. And why this one? Well, I already stated that the Dow was the weakest of them all. Go back and listen to the videos and commentaries on the indices. I stated that Dow has been showing itself the weakest. So that's not surprising when you see the 1,000-point drop on Friday of last week. When the second stage of distribution comes in, it wipes it out. And here, same thing. We have a nice little decline on Friday, but this is the strongest of the indices. And you can also still see this here with this low not being taken out by that low. See that? Where that same low here, respectively, is here on NASDAQ. It's here on S&P. Friday, it took it out. See that? So this is divergence that's showing bullishness. And as I mentioned, I felt that we still may see some continuation on the upside. And it just may be led by NASDAQ. NASDAQ still might see a higher high here, and it's already showing relative strength compared to the indices, where it can't go lower than this low here apparently yet, where the S&P has done it, and then obviously the Dow has smashed it. Okay, and now I'm going to take you over to TradingView and show you a trade setup I did this morning, walk you through that a little bit, and then I'll show you the euro-dollar trade as a final recap. Okay, and it should drive into that sell-side liquidity pool. I'm looking at the bullishness on dollar index, and it's finding support at its bullish order blocks on the 5-minute chart. So therefore, distribution should come in the form of the 5-minute pound dollar. And you can see there's multiple 5-minute candles before I entered. All of that is time distortion. Okay, and we're reaching down into that sell side liquidity pool. I'll show you the running numbers here on the open trade. I'll show you where that $774 came from. All right, small little retracement in here. It should not have any heat on my position. Okay, I want to see it trade lower. Dig in underneath that low like it's doing here. Nice little expansion. Now, I'm not convinced this is all there is, okay? I'm thinking it's going to go lower. But I want to take something off because my goal is I want to get the account to reflect 10% return, or a little bit over 10%, which would have to be 11,000 in this paper trading account. So I did 7.74% on Friday, and that was with 3.5% used for risk. This one here obviously is far less, it's 2.5%. And now I want to see it have an attack on that new short-term low. And when it trades below that, then I'll take my first partial and secure hopefully the $10,900 threshold. Okay, so I'm taking the majority of the position off on the first scaling. This is all income-based trading. It's not trying to hit grand slam home runs. I'm not trying to get the whole position with my whole initial leverage used. I'm just trying to build the account, taking bite-sized pieces, looking for surgical strikes, and I took my partial there. All right, now I have a remaining standard balance, or remaining balance of a standard lot, rather. And I'll look to see if I can peel off enough to secure the 11,000 account balance I'm looking for. Now, these are things you want to do in the beginning because it helps you as a developing student get that reward that you're looking for, that, you know, that karate belt of a different color. Okay, as you progress through. If anybody starts in martial arts and they just get with a white belt when they first start and they have to wait until they become a black belt, it's really hard to have discipline to hold on to. And I just took another partial there, and that secured the 11,000 threshold on the account balance. So no matter what the position, if it gets stopped out where it's at now, it won't take away that balance of a gain of 10%. Again, hypothetically on a paper trading account. So now I'm just going to sit back and watch, and if I can get another run below that new low, I'll take a partial below that as well. And again, what I'm illustrating here is how running down equity, which is when you're short, you're taking out partials as it takes out new lows. You do not, in the beginning, look to hold on to your ultimate objective. And I just took another partial there. So I'm constantly building the account bottom line. I'm not trying to trade with ego. I'm not trying to prove to somebody else on the internet that I'm the best and the best, okay, or the GOAT. I'm not trying to be a king among peasants. I'm not trying to be an all-star. I'm just trying to build an account balance and do it consistently. And I took another partial there. So now I have the equivalent of one mini lot. At this point, even if it never hits my limit order, okay, if it never hits my limit order, I don't care, because I've taken multiple partials off at logical levels, which I'll show you the reason why it's logical, where I'll take them out in a moment. But as it starts to retrace, let's say you're looking at it and you say, okay, I don't feel comfortable with the position now, and it may stop me out, or it may go into a period of longer consolidation, which you don't want to be a part of. What makes you stay in the trade? You. What keeps you from getting out of it and just keeping your mental equity liquid? Nothing. You just simply say, okay, the position's not moving like I want it to, or it's not moving fast like I want it to. after I've taken several partials, is it worth your mental capital? Okay, in other words, the peace of mind of you watching these charts or holding the position. Can you function? And it may seem silly that only a mini lot would have this much effect, but when you start trading with live funds, you're going to be surprised how little that money is in terms of, well, value, but it also has an immense amount of leverage over your psyche. So you just close the trade. Okay, we are looking at the euro dollar. This is the trade I did. It was kind of like a bread and butter setup. I'm going to show my son on Friday. And this entry was here based on the order block here. So we had a low, rallied up, took out the relative equal highs. When it's bullish, drops back down in. I'm going to be a buyer as it does so. I bought it. First partial was taken here as it trades up into that imbalance I mentioned on the hourly chart. And I'll zoom out to the hourly chart again in a moment and show you where these relative areas are. Took first partial there. Again, let me show you the entry here. First partial there. And then the limit order gets tagged out here on the balance. Okay, as it trades up into the daily bearish order block. Now I'll zoom out to a hourly chart. Here's that imbalance. Consolidation, distribution, redistribution, smart money reversal, low risk buy, accumulation, reaccumulation, rallies up. What's it reaching for? The imbalance that's in here. On the framework that we've already traded into a higher time frame discount array, so we don't want to look for shorts. So we have a market maker buy model here and a larger market maker buy model here, which is what I was trading on and reaching up into this premium array and then the daily bearish order block. So buying on the order block in here with the expectation we're going to run through an imbalance, rebalancing, and then the bearish order block. Okay, I don't need the highest high here. I'm looking for a retracement based on what we saw in last week's price action. And again, I'll take you back out to the daily chart. You can see that red level. It is the bearish order block there. Okay. All right. So what else I got to owe you here? The euro I just showed you, and then pound here. And there's today's business. I'll drop down to a 15-minute time frame. All right, market maker sell model, distribution, redistribution, small little fair value gap in here. See that? Let's zoom in a little bit. All right, so we have small little imbalance here, and you won't see it here on the 15-minute time frame. On the 5-minute chart, you will see a period on the buy side of the curve where it's accumulating. Now it's distributing, okay, because we're on the sell side of the curve. Attacking sell side liquidity when the market is bearish on cable, bullish dollar. So we look for a deeper pass through, not just a shallow run. Also, if we're going to take out this low, we can use market structure to get swing targets. And there's a fulcrum point here. So we have this high and this low. Price broke below it. I'm trying to get in near it. Okay, so how much further can it go down? Well, we have this level here, 133.02.3, or 3 pipettes. Essentially, if it's going to go that low, what's it going to really reach for, folks? It's pretty obvious. It's going to reach for that 133 big figure. So if it goes to 133 big figure, you could elect to hold on to it to see if you can get something like 10, 20, 30 pips and as much as 40 pips below it. But for the sake of bread and butter, for the sake of just getting in there and finding your 25 pips for the week, that's what I'm really just essentially offering here. So the entry is here, which you saw in the recording just a moment ago. First partial, second partial, third, fourth, and then finally collapsing the trade. And that was a manual collapse. You saw that. As the market's trading down into this objective in here, and or below this low, I want to be taking partials around that 20 pips, 25 pips, in that area. I want to kind of like throw my orders into the marketplace to try to get paid around that area. So now with this here, we'll drop down to the 5-minute chart. Okay. And here is the entry candle. Now, if you watch the video closely, and you'll see that I actually put the order in incorrectly. I had it toggled to set to limit order. And I didn't want a limit order. I wanted a market order. But Bailey was walking across the laptop. And I was trying to shove her out of the way real quick because she wants her belly rubs all the time. So I'm shoving her out of the way. And I didn't notice that it was still set on limit. So when I put the order in immediately, it flashed as limit orders pending. And I'm like, whoa, this ain't even right. So I close those, cancel them real quick, and I go in with market orders, risking 10 pips to get 20 pips. So anyway, the point is we're looking for the framework that can build to a 25 pip a week harvest. Now, while this wasn't a total 25 pip haul, it's how you build on it, okay, and how you go into learning the logic, the theory, and these core content lessons and the commentaries, the ongoing mentorship, when I'm teaching you how to look for withdrawals on liquidity, looking at the bias, looking for the market structure, how to use that market structure and find a narrative in all of that. That's what I'm illustrating here, okay? When you see things like this, you can't argue with it. You can't say, well, it's hindsight, or he cherry picked it, it's this, it's that. It's right out of the core content, okay? And I'm using the same account as I'll show you here, not finding one trade and resetting and doing another trade. What am I going to do here? Account history. All right, there's the business. So, first partial, hitting the limit order on the euro. First partial, second partial, third, fourth, and finally collapsing the trade manually on the pound. And there's the over 10% return in 2 trades. And I think if that's accurate by me saying so, I think that's the threshold that you have to do for an FTMO account. Like you got to get 10% or something. I don't know if it's like 2 weeks to give you to do it or 10 days. I don't even know. But 2 trades, consecutive days, Friday and then Monday. If you know what you're looking for, folks, if that's the route you want to go, getting funded, if that's the avenue you're trying to strive for, you don't need to work hard to get it. Like you don't need to work hard at all, but you need to know what you're doing. So if you look at the imbalance in here, the fair value gap, it trades up into that, and then we go into time distortion all through here, and notice that it's occurring right where we had a down close candle here. So this is accumulation, then it goes higher. This is accumulation, then it goes higher. All of these places where it sells off are old areas of accumulation. Here, now it becomes distribution. Accumulation, before it rallies, becomes area of distribution. That's a market maker sell model. That is not Wyckoff. Okay? It's not anything. It's not Chris Lorry's stuff. It's not Elliott Wave. It's not supply and demand. I mean, you know the routine here. This is highly specific things, and it's not support and resistance. It doesn't line up for support and resistance. It's the logic, the narrative of what makes it do what it's doing. That's algorithmic. Okay? The liquidity here is where it's going to draw for and through. So it's going to go down into this and then expand. Now, notice what's occurring. We have the first stage of distribution and then the second stage of distribution before running into the liquidity. Huge, huge insight right there. If you're seeing the second stage of distribution in a market maker sell model when it's bearish and you think it's going to go below these lows for liquidity, and it's bearish now, we don't look for a shallow run. And we also know that this second stage of distribution is going to have a nice expansion on the downside because it has to go through here and dig in deeper because it's bearish. Versus if it was a bullish market, it would just poke its leg in the water a little bit and then start to go the other direction probably, or consolidate. Whereas because we're bullish on dollar and we're bearish on foreign currency, it's going to dig through into this liquidity farther and reach down into a big figure. And ultimately it trades down to here. Almost down to the 1.5 standard deviation. See that? But nice clustering in here. Clustering is where I'm kind of like showing you where my partials are being taken. And it's the manual collapse right there in case you haven't noticed it. It went a little bit lower, but it's okay. I'm teaching you how to have confidence in what you're doing, execute and build more confidence and experience. That experience is going to serve you well, but until you get into practice using the things I'm teaching you, even if you can't do it live like I'm doing here, you look for this stuff in hindsight and you backtest it. Backtesting is simply doing what I'm doing here and saving the charts. Okay? You would highlight little areas in your chart with little arrows. I guess you would do something like this. Where's the reverse of that? Good grief, it's probably staring me right in the face and I can't even find it. Almost got 50-year-old, there it is. 50-year-old eyes coming. All right, so instead of having what you would have a real execution, which is what these are here, you'll be using something like that. So obviously when you go over top of that, it highlights like that. When it's an execution, it'll pop up a little window and give you information, whereas this is just, it's added after the fact. So my errors are not lipstick, they're real executions, they're real entries, and you can't fake that with TradingView, okay? But you would do your own charts if you can't do the trade live, like if you're coming home after work or running your business or in school, you put in your annotations like this. Like this is where I would look to take partials because it went below this new low. Or you'd have an arrow right here like I have because it went below this new low here. All right, so you would annotate your chart that way and show what you would do based on what you learn in the core content. And by doing that repetitively and having example and example and example of you backtesting and showing you how it would have panned out in perfect hindsight, granted, but this isn't hindsight. Okay, it's theory being used to execute and showing you what it looks like, what's the framework. All of this over here with the first run into that imbalance, that candle's the ideal entry. Then we went into distortion by time. Okay, it's just marking time. At the same time this is doing this, okay, from 805 to 850. Okay, watch what happens in the dollar. Okay, and here is an order block. There's 3 consecutive down closed candles, and 805 is here, and bam, hits it right there, 840. Trades into the order block there. I'm expecting what in the dollar now? Higher prices. Where did I enter? On cable. Right as this thing hits this and starts to run, I'm expecting higher prices in what? Dollar. So therefore it's going to, like a teeter-totter or a children's playground seesaw, if the dollar's going higher, it's going to press down pound dollar. So that's how I'm reading it. I'm looking at, you don't see me doing it because it's too much to have on one chart. But as this is occurring, I'm looking at my other monitor that has the dollar index. And as it's trading down into that order block, I'm expecting this to rally. And that's going to create that what? That decline on pound. And there you go. Okay, so you're blending the elements of a market maker sell model with the logic of the sell side of the curve matching the buy side of the curve. This is accumulation. Over here, after we turned at the highs and started breaking down, that second stage of distribution, that is your unicorn. You're hunting unicorns, okay? As silly as that sounds, this is the easiest delivery to profitability in your setups if you know what you're looking for with this logic. Now, you might look at this and say, this doesn't really look like a market maker sell model. That's because your infancy as a trader, you don't see it as it is. But over time, it'll make more sense to you because you're seeing a consolidation here, and the market rallies and it hits a level, daily bearish premium, and then sells off. And we're looking for lower prices below this low, and we get it in the form of swing projections here. And you don't need it to hit your objective. That's the thing. Like, if you have a target, treat it like that's the best case scenario. But if you're taking off partials ahead of that, do not hold on to this idea, reward the risk has to be this, or you won't be successful. In the beginning, you're not going to hit 5 to 1. So imagine trying to strive to get to 5 to 1. How long is it going to take you to get to that consistently? Let alone, finding 3 to 1. If you go in, you're looking for 2 to 1. That's fine. If you're practicing with 1 to 1, you're getting experience. You're executing. You're desensitizing yourself to the results. You don't care about what the results are going to be. That's the benefit of going in through proper training and proper mentorship, where you're not looking at the money. You're getting used to reading price and the tape. And by doing that, you're not influenced by the tug of war of fear and greed. You're not worrying about missing out anything, because what you're framing, 1 to 1, 2 to 1, they repeat a lot, multiple times in the same day. But I want you to think about it happening at least once a day. And if you can go in and practice looking for 1 a day, you might not get it. But if you get 1 that pans out and it gives you that 25 pip, threshold or harvest for the week, that's what you do. You do that and you log it and say, okay, I did it. Now, can I do it again next week? And that's how you build consistency. In the beginning, you do not try to go to get 500 pips, okay? That's unrealistic. If you can consistently find 25 pips every single week, I promise you, the same thing you're doing on these lower time frame 5-minute charts and 15-minute charts to get a 25 pip run, if you use an hourly chart or a 4-hour chart, the same logic, you'll find 50 to 75 pips easily. It's the same scalable logic, just applied to a higher time frame. But how many examples can you practice with a 4-hour chart in a week? Not many. But with a 5-minute chart, you get lots of experience, lots of opportunity to engage with the logic I'm teaching you. Okay, so anyway, the point is, nothing red, right out of the box, ICT core content again. And I guess this is like FTMO passing, because when you're doing an FTMO challenge, you're really trading with a demo account anyway. So there you go, in 2 trading days, not even hitting grand slam home runs. If that's the company you're going with, so that we understand, I'm not repping FTMO. I don't have any affiliation with any funding account, business or outfit. I don't put you in any direction. I'm not saying go to FTMO. Okay, I'm just saying that if you are considering that option, you don't need to work very hard to get it. Okay, but once you do get it, and if you do get funded, don't change it. Don't go in there thinking, okay, now I'm going to go for the 75 pips, 100 pips a week. You don't need that. You don't need that at all. So I'm showing here, if you can do 10% once a month, that's enough. Like if you are trading, I guess, with what would be a $100,000 account, if that's what they give you the leverage of, and you get 10%. Assuming, and I don't know the math on this, I don't know what their split is, but let's just say it's 60-40, and I might be high. But if that's the case, and you took 10% out of an account for the month, and you used $100,000, that means that you netted 10 grand. And if you get 60% of that, that's 6 grand. How long is it going to take for you to get your own money in a position where you can take out in the span of 3 months or less, where you have $6,000 with the equivalent of the effort that would be used there? Now, I know there's a lot of things being said about, well, you're not really trading with that amount of money, and you're not doing this, you're not doing that. I don't know the real mechanics behind the scenes, okay? I know that they have real tight risk protocols in play where, if you lose this much, you can't play no more. But if you pass it, you get your money back. That's my understanding with your first withdrawal. That's why you don't really want to push it too hard. Don't build it so hard on the first withdrawal. Get your money out of it and get some scratch, get some paper out of it, some real money, if it's possible for you to get there, because some of you still might not be able to do it because you're rushing to do it, because you're rushing to get to that money, when you should be just consistently and methodically going after the routine of doing this. That's why this stuff is easy to me, because I know what I'm doing is a process. It's a routine. It's a thing that repeats. And all I'm doing is executing based on that reoccurring theme, logic, and narrative. And you don't need precision. I just showed it here. You don't need the best of the best entry, and you don't need the best of the best exit. And if you do this consistently, once a week, set that up in your mind that that's your initial objective. And then once you hit it, your goal is to forever be able to find that every single week. And then once you're able to do that, say you can do it for like 3 months in a row. What do you do then? Bump it up. Bump it up to, now you're going to try to get 40 to 50 pips. And then aim for that each week. And if you consistently hit that for 3 months, now think about what you got. You got 6 months of consistent profitability and track record and confidence that no one can take from you. No trolls on YouTube or Twitter or Facebook can take it from you. Instagram guys can't influence it. They can't minimize it. You are able to find setups. They cannot take it away from you. It's like riding a bike. Once you understand that part, nobody can take that from you. And that's a beautiful state of being because it is so empowering and it's so achievable. Every single one of you folks in here can do that. But you're all feeling this rush. Okay, I need to do it right now. You don't. You need to just think about what you're doing at the moment for this particular week. Where is the framework? Where's the logic? Where is it likely to give it to me right now? And don't force it. Don't be in a rush to get it. Don't think, oh, I think that's going to happen. It's going to happen right here because I think. No, it's going to be obvious. It's going to be obvious to you after you've been studying. Reading price in hindsight and looking at the commentaries and watching how I call it to a specific level and it goes there. That is all conditioning. That's all training. And you're getting pseudo experience from that you're going to lean on when you look at live data. And all of that comes together. But if you try to rush it, and like, I'm going to go in there and I'm going to just go after it right now because, I might get lucky and I can get funded and there it is. Nothing magical happens if you guess and you do something that was without skill and say you pass a funding challenge and they give you access to funds. If you're not absolutely certain that what you did to get there was something you've been doing for months and months before that, you're wasting your time and you're going to lose the access to that account. Think about what I just said. Most of you young men in here are dying to just take the couple $100 that you require to get funded and take the challenge to do it, to get that account so you can go on social media and say, I'm funded and rep an ICT. You don't need to do that. I'm more impressed if you don't do that and you're just consistently building up and not rushing to just get that past FTMO or whatever the funding account is. I don't even know off the top of my head what the other ones are. The FTMO is just the easiest one to reach for because that's all you see on YouTube. But you don't want to rush it. And I promise you, if you go into it with this logic, it will be boring. And that's exactly what it needs to be. Just like your job that you probably hate because it's mundane and it's repetitive and redundant over and over and over again. It's the same stuff. That's why you hate doing it because it ain't giving you any more money than you did last week. But you know it like the back of your hand. You know what you're expected to do. You know what your boss wants you to do. You know how long you have to be there. You know when your lunch break is. You know when it begins, when it ends. You know if you're going to be late, if you don't get there by this time. You know all those things. And that's how you have to have the market be just like that. This is your workplace. And you're the boss. You are the boss. You're in charge of giving yourself a raise, and you're also the same person when you do something wrong. You take the money away from yourself. The market isn't doing it. You're doing it. If you do something wrong, you have to take that responsibility and own it. You can't say, "Oh, ICT gave me this stuff. It doesn't work," or ICT, he likes euro dollar and pound dollar. And if he would have just talked about Aussie dollar, that would have been helpful to me. No, own the responsibility. You have to own it. And then once you operate in that, and if you take a loss or if you miss opportunities, and you still stick to this process and it still works over time, maybe you'll have 30 losing trades over the course of 6 months. Okay. But over time, that 30 trades that were losing transactions will diminish, and you'll start to see there's going to be more winners. And that transition from not really knowing what you're doing, floundering, and it's uncomfortable. That stage, that is the stage that everybody hates. And the weak-minded individuals that system hop, they jump from one thing to the next. They're the first people that leave. They quit. Not just here, everywhere. That beginning stages of, okay, I got to put my hands to the wheel and just start driving this thing myself. I can't rely on anybody else to do it for me. And then you realize that you're the one navigating. You're the one deciding whether you're turning this car on or off. You're the one that pushes the acceleration pedal down. And how far are you putting it down? Are you putting real money in behind something you don't even know what you're doing? Every person that comes through my mentorship or anybody else's mentorship that rushes to go into live funds without having a boring track record on paper of logging examples of where you see where you've done it right and consistently doing it over and over again for months. If you don't do that and you go right into live funds, you are guaranteeing yourself failure. And I'm promising you are going to lose. You're going to blow your account and you're going to swear up and down by God that it was this stuff here that you learned that was flawed logic when it's you that sucked. Yeah. Just like I sucked in the beginning. I rushed to get into live funds because I needed to get out of my job. You don't need to get out of your job. You need to stay in your job. You need to be working, making your ends meet as best as you can while you develop yourself here. This is your replacement, but you have to grow this. Right now, hearing me talk, bloviate on about things about what you already should know in the mentorship content, but I'm showing you examples of it. It doesn't transfer from you just watching and you understand how to do it and you can walk out there with live funds. You have to condition yourself. And there's going to be a lot of times where you go out there and you do it and you fail. And that's the part that you have to learn the most from. How are you going to deal with failure? You got to look at it objectively. Okay, what did you do? Not what did my concepts fail at. What did you do as the operator of that execution, that transaction, that trade? What did you fail to observe or do or not do? Because I'm afraid that that's the biggest bitter pill that most of you will gag on. Because the responsibility is yours. It's not mine. It's yours. And that's why it's important for you, if you find success, you don't co-sign me on that. Your success is yours. You did it all by yourself. You owe nobody anything. If you start making live funds and money, I'm not holding your hand doing that. You did it on your own. And you should feel good and proud about that. But on the same side of that coin, let's be real. If you blow up, that's your fault. That's not my fault. That's yours. And there's people in this mentorship, and there's people out there on the YouTube channel community that are absolutely killing it. Killing it. So there's no excuse for any of you to say, well, I can't do it. No, you can't do it the speed and the timing that you want it to be. You have to grow into this. And some of you are so stubborn. You're so stubborn and impatient. And if you just relax and let yourself grow, that same level of stubbornness and commitment, once you understand what you're doing, you won't deviate from it. It won't matter who tells you anything about what you're doing. It won't matter because you're like, pound sand, pal. I know what I'm doing. I found my way. But you gotta let your guard down. In the early stages, you have to let it down. And you got to feel comfortable being uncomfortable because it leads to growth. And if you can't do that, I'm telling you with all sincerity, I swear to you this is the truth. It won't matter what you do as a trader. You will fail. It doesn't matter what system, what approach, what teacher, whatever you do, if you don't allow yourself the uncomfortable stages of development in the early part of your learning, You have to endure that. There's no way around it. There's no shortcut, and you have to go through that process. And that's what you grow from, that growing pain stage. And sometimes it's longer than you're going to want it to be. And other times people will go through it and they're like, man, this wasn't as bad as I thought it was. That's a rarity, but it still happens. For me, it was hard. It was long. And I don't make no bones about it. But nobody can sit in this mentorship and say, this stuff doesn't work. Because it works every single day, every single week. It's there. But you got to look for the market that's giving you that setup. Euro wasn't this clean. Pound was. Dollar was communicating with its opening gap. It found support, found a bullish order block. New York session open. Boom. Rally in dollar? Okay. What do I see in the pound? Market maker sell model. There it is. And I executed with the idea in mind that this is about the aptitude you would have if you were just getting into the groove of doing this. So that way you're not getting the best entry, you're not getting the best exit, but you're learning to take profits. Now, if I posted this chart right now on my community tab, and we all had everybody in the same room, which is impossible, but this just play devil advocate for a moment. Everybody would look at this area here and clustering of, okay, he got out here. He got in here. Okay, I guess that's okay. But he got out here. But look, he didn't get out down there. And these same people don't even have a trade at all. Or they probably were going long on pound. So you're always going to have some kind of critic. So don't invite it. You are going to be the hardest critic on yourself. Nobody out there is going to troll you harder than you will when you fail. You're going to say, oh man, I hate this. I'm never going to get it. I want to quit. This is harder than I thought it was going to be. And then you quit. And that's always an option. Quitting is always an option. But you're never going to get here if you quit. And you have to fall in love with this whole idea of not knowing something right now and pressing into that uncertainty and practice, even though you don't know the outcome, because guess what? That's what every trade is. I don't know when I was entering here, it was going to go down below here into this area here. I don't know that. I have to submit to it and see if it's going to give me that. If it doesn't, then I have to manage that. But I'm teaching you how to find the highest probability for these signatures to lead you to profitability. But some of you, and I'm not hearing anybody give this vocally, either in email or, outwardly, but I know there are some of you are just hands crossed your chest right now, scoffing and whatever. It ain't whatever. It's what it is. It's work. It's effort. And it's not easy in the beginning. You're not going to get this right away. There's so many questions. You're trying to fit everything into every condition and circumstance in the marketplace. There's no COT data used here. Notice that? I did not use anything with grading price swings. Notice that? There was no seasonal tendency implied here. See that? All of those things are tools that you're going to refer to. If it's giving you insight, then great. If it's not providing you any insight, then you just don't worry with it. There's enough tools for you to come to a conclusion of whether or not this market's going to go higher or lower. Where's the liquidity? Is it time of day where you should be trading? Are we in New York and London? All right. Now, as we're going into this decline in here, the 10 o'clock hour is when things can turn. From 10 o'clock to noon, sometimes as late as 1 o'clock in the afternoon, this is your London close time period. And we're seeing the low form here, right there at noon. You don't need to know right now, or even in the next 6 months, that it's going to go to this particular level at noon. You just need to know that taking profits below this lower here, around this area here, that's enough. That's enough. And over time, taking these small little surgical strikes and eating the elephant one bite at a time, you're going to get stronger. and you're going to have more experience, and you're going to see things that you're not seeing even in this example here. But you'll learn new subtleties about yourself, what you perceive in price action, how that is meaningful to you. And you will find your own niche in this. I promise you, it sounds mystical, it sounds lofty and fairy tale-ish, okay, if that's even a word. But that's what happens. You find something that you see in price action that makes so much sense to you out of all the things I'm teaching, and there's a framework that you like. And I talked about one in the Wednesday video last week where there's a fair value gap and I think it was a bearish break or something like that. If you have that, that's one of the most powerful setups because it repeats a lot. But there's also little, subtle signatures that link up with other ones that might be your bread and butter setup that you go in and you look for that. Just because it's not one of the 12 models in the charter group level doesn't mean it's not your model. Those 12 suggested execution-based ideas, okay, framework, if you will, or what I call price action model, they're just suggestions. They might inspire you to do something entirely different and say, I was looking at this model, and as it was being explained, I felt that this was close to an idea I had about this signature and this PD array lining up when it's bearish or bullish. Well, that's your unique model. And that's even stronger than mine because it links to your personality, your way of interpreting price. There's nothing better than that. When you find that, and if you give yourself all time and opportunity to do it, and forgive yourself for not doing it as fast as you thought you should have learned it, when you do that, and then when you do find your unique model, that is the unicorn. That is the holy grail. That's the best system in the world because it matches you. It's like symbiotic. It becomes you and you become it. And there's no separation between the two. That is your algo and you are the algo. You won't need any input from me. You won't need other people's opinion in the commentaries, or not commentaries, in the community. All the charter members, y'all can talk. Every one of you have a voice now. And you can be in here talking. You can, and some of you are. Some of the folks that speed racered through 2021 enrollment and got to charter member faster than anybody else did. Some are out there saying, hey, I'm confused now because you went through it too fast. Others are like, I'm so thankful I'm here. It's just so great to be engaging with other people. You have a voice. You can talk. Okay? You can exchange ideas. I'm encouraging you to do that because by you sharing your interpretation of what's going on and critique the models. There's 12 models. Critique them in the sense that if it doesn't jive with you, don't be afraid to say this one doesn't make sense to me because I'm confident that they make sense to me. I can use them. But I know that it isn't going to match everybody. But when you share your criticism about them, obviously be respectful in the sense that, okay, I see this model here. It doesn't make sense and I can't see it here. But then talk about what it is that you struggle with. And maybe someone else has something that they've applied to that model in replacement or along the same lines of the general foundation of that particular price action model in charter level. When that happens, it creates and opens a dialogue that will unlock someone just reading, not even being a part of that conversation. You'll think, oh, light bulb moment. Wow, yeah, I didn't think about that. And then you go into your journal and you go into the charts and you start backtesting, and then all of a sudden something magical happens. Okay, you find your price action model. And it's really just like that. Like, you're not going to have me sit down and make 12 new models and still fill in the gaps for those people that can't find any one of the 12 models to line up with them. It's going to be a unique thing for each of you. And that's scary because if you feel like you're struggling while you're going through the core content and you're not a charter member yet, and you have 1,000 questions right now, and you're thinking, oh my goodness, you're putting all that responsibility on me, Michael? I'm already having a hard time figuring out what order blocks to buy. You're asking me to pick my own price action model. You have not allowed yourself time to get in this stuff and practice and study and see it over and over and over again. It's not going to be watch it, look at it a few times, write down 10 pages of notes because you have to have some kind of notes or you didn't do your work around here. No, it's months of it. And by doing it and studying old data, you will find a way to find your specific engagement and price. I can do all 12 of those and more at the charter level. I can do every single one of those price action models. I can also do things outside of them. The things outside of those models are what you're going to have in your own unique model. Because even though if you settle in on, say you like price action model number 5, which is amazing, okay? If you use price action model number 5 and you be trading with it for, I don't know, a year or two, maybe 3 years. About that time, you'll start picking up on subtle nuances that you as a trader start doing or observing in your trading. And that will enhance price action model number 5, where it becomes something entirely different. The foundation may be on model 5, but you end up morphing into some new price action model, but the logic that was used for model number 5 inspired you to pursue a different approach, not abandoning model 5, but using it to investigate and backtest a new idea. And then you may end up coming up with something entirely much more powerful than any results you get from model number 5 that you've had. That is growth. That's maturity. That's what you have to open your mind up to the likelihood of occurring. But right now you're not even considering it because you think it's, well, he's going to give me a trading plan and that trading plan is going to work for me. It may not, but it may open up your understanding about where you're having barriers. And that's what charter members should be doing. They should be engaging one another in the forum because there's your sounding board. Your peers are there in charter. You can't talk to anybody when you're coming through core content. That's normal because you have enough problem of just going through the content and practicing. Talking to other people and wasting time and looking at other people's ideas or whatever I'm talking about or other people are talking about on the charter level, that's not going to be a secret recipe for you to get around the work. Some of you think that's what's going to happen or why it should be allowed. No, it's a distraction. Because there's a lot of also useless ideas that are being talked about that has nothing to do with trend or trading or technical analysis at all. There's certain threads that are just, political stuff or whatever's going on in the world with the vaccines and stuff. And that would probably, steal some of your time and energy. That is a distraction. That's why I tell you, stay off of social media. When you're going through core content, you have 12 months of boot camp. And that's hard stuff. That's a lot of content to go through. And there's a lot of excuses that you can come up with to quit. And I'm not going to ask you to stay. If you want to quit, it's on you. You know yourself better than I do. But I also know humans like to toss in the towel way too early. And give yourself time. Give yourself a real chance to do this stuff. Because I can promise you, I can sit down here every single day and do this and use this same account and do the same thing every single day. And while they're not 50 pips, they're not 100 pips, they're not 1,000 pips, they still will grow this account. Small little bite-sized pieces every single day. And you don't need 25 pips. You might get 15. You might get 10. You may get stopped out. You may get almost to 10 pips and then something in the trade shows you that you're wrong and you close the trade and you just cover the costs and maybe a pip of profit. Or you may get stopped out. That doesn't change or negate or cancel out the logic or the efficacy of these concepts. There's so many variables to trading that you as a developing student have no idea. You think it's a black and white binary, push a button, there it is, and money drops in your lap. And it's easy. And let's go do it again tomorrow, or let's do it again in 5 minutes because I have time to do it and the markets are still trading. All of those things, that's toxic thinking. That's people that have no idea what they're doing. And that's exactly what I was in 1992. I was in a rush. I put money in an account that I barely could afford. Overnight, 50% of it gone. First trading opportunity, first trade, 50% of the option value gone, just like that. Welcome to trading, Michael. You just got baptized in the fires. And on that note, send me the rest of my money. Closed the account, and that was it. And a few months went by, and Larry Williams stuff fell in my mailbox, and I pursued that. I didn't quit trading. I quit that approach. But I'm proving to you here now, weeks and months and years, that this stuff works. I wish I could make it easier to take it from my head and understanding and give it to you that same way. I do my best to try to do that. But there's no way for me to simplify it more than I'm doing right now. I'm doing it for you. I'm entering the trade. I'm managing the trade. I'm showing you how it's done. That is proof. That is theory using the execution to prove the theory. So no one can argue with that. And I'm framing it in a way where it's realistic for you as a developing student. What should your initial objective be? What's your target? When you first start looking to get into demo executions, you do it like this. You look for these little places where it makes sense for the market to go up from where you're looking at it right now and go up to a specific location. And if that range, in other words, I'm trying to get in up here, why am I trying to get on this candle? Because it went up into that fair value gap and it is inside of this old area of accumulation where it should go up. After the market takes a high and breaks down to the right of that, everything should be looking to sell off. But everything matches up with a old area of buying, now selling. Old area of buying, now selling. So while it's in here waiting for the dollar, that's why the time distortion is occurring. Okay, I'm not sure if I mentioned that earlier. But why is pound consolidating here? It's waiting for dollar to drop down into its bullish order block. Then once it does that, then it's free to drop when dollar's allowed to rally. So I'm showing you comprehensive understanding. I'm showing you visibility. There is no delayed data on TradingView. This is not MT4. These are real executions. You watch me record it. You see the entire history. There's nothing hidden. Okay, so when I run the accounts up, because some of you are probably thinking, well, how do you get these accounts to run up like you did? It's a lot of these right here. But as it's going down, every time, well, let's look inside here. Okay, I know this video is really long. But you know what? We had a couple of days off last week, so you owe me some study time. You're looking at me like you owe me some videos. I'm looking at you like you owe me some study time. All right, so inside this range here, this is basically what I was looking at and why I was expecting it to drop down in here. Inside this range, this is what I had visualized from me entering and going below these lows and matching up right in here. This is about where I was aiming for in the logic and framework for me going short here, trying to profit, quote unquote, going down to this level. I wasn't looking over here in time. I just wanted this much range. And if it took all the way till noon, that's fine. But it rallies below these lows here pretty nicely. But let's go down into a 1 minute chart. All right, so here's the 1 minute chart. So I'm entering on this candle right here. Okay. Up close candles is your bearish order block. Right inside of that, sell off. So it sells off, comes down here. Right there. As soon as it does that right there, what I'm doing is I'm starting off with the largest position I can open up with 4.5%. Okay, so 4.5% would come in. Not that this trade was 4.5% because it was only 2.5% risk. But let's just say I go open up the trade with 4.5%. And it breaks down and it comes back into an area of institutional order flow entry drill. Why is this institutional order flow entry drill here? because there's no data over here. We're below all this. So this is a pool of liquidity. So that's a gap there. And it's not just fair value. It's institutional order flow entry. It should not fill in. So it runs up to this candle's high and just a little bit above it. I would sell short more. So I would go 4.5% here, whatever that leverage would be, but it wasn't for this particular trade. Then I go in and put in like 3.5%. And then it breaks down, comes back up into an order block in here. And then I'll go in with 2.5% more. And it breaks down here, back into a fair value gap in here. I can go short again here for now, say 2% or 1.5% more. I'm using all the cushion of the new equity and putting in new positions, but scaling them down. Okay, the largest position at the entry, and then every time it gives me another subordinate entry that supports the idea I'm looking for, going lower. And then once it gets close to where I'm trying to get at, I can't enter any more new trades because we're real deep in a discount. So by doing this within the framework of that setup, it builds my positions larger. And by doing it with a 30-second chart, you get more setups. And every time all these little things move around, it's the same idea. You're just pyramiding in, pyramiding in, pyramiding in. The market may not give me multiple levels of scaling in as much as another leg in price may do it. Like for instance, like this entry here to get out down here, there's about 4 in here. But it may not offer the same number. It may offer 2 in another price leg where it just runs too quick and doesn't give me any kind of retracement, doesn't give me fair value gap, doesn't give me a bearish order block, doesn't give me a stop run. So when I'm running up the accounts, I'm looking at very small time frames like 1 minute or the 30-second chart. And well, let's look at the 30-second chart inside this shaded area here. And I know some of you are like, man, in this video it's too much. All right, there's the entry, just the shaded area. It doesn't show because I don't have it, I guess, showing less than a minute. But the entry's in here. And you have institutional order flow entry drill here, there, fair value gap filling in right there, institutional order flow entry drill here, fair value gap there, and then sells off. So you have a lot of setups here on the 30-second chart that don't appear as clean as you have on that 1-minute chart. But you have to have the logic that frames this overall price structure, or none of this stuff's going to work for you. I know some of you might look at this and say, oh, this is the secret. I'm going to use a 30-second chart and it's going to be so easy. No, you have to understand what that market maker sell model was giving you. Over here, and this would sell off and go deep into this liquidity pool down to this level here. That framework needs to be understood why it's possible. Because if you don't have that, it won't matter if you're using a 10-second chart or 1-second chart. Or a tick chart. It won't even matter because it'll be poor logic applied to a market that's predisposed to do this. If you don't expect this to occur, you're going to get caught off the side and hurt yourself. So hopefully this has been insightful to you. Hopefully it's got your gears going, and if not, inspired you to at least dig into deeper study. And I'll touch base with you tomorrow on Tuesday. Until then, be safe.